Today I would like to talk about Baidu. It's a Chinese company which has a similar business model like Google. They have one of the biggest search engines in China. They also have other businesses. So for example, they have the cloud business as well, which is a growing market. They also have the autonomous driving. And they have a similar business like Netflix with the ICIYI. So it's an interesting company. And when we take a look at the stock price, we can see in 5 years it didn't happen much. It's actually down close to 13%. And it was up significant in 2021, round about 180%. And from this, it did all the way down to 70%. So right now, it looks cheap from the stock price, but we have to take a look at the financials to find out more if this company is actually undervalued. The first thing we can recognize is the market cap of 249 billion Hong Kong dollar. This is round about $32 billion. So it's not a small company anymore, but I think it has still enough room to grow. We can also see this company doesn't have a dividend, so they're not paying any dividend to the shareholder. Now I would like to take a look at the financial foundation. The first thing we are looking for is revenue growth over the last 5 years. So we can see here in 2019 it was about 121 billion. And in 2023 it's now around 148 billion. So we can see we have the revenue growth, but we also have the decline since 2021. So overall, it's a check here. We have the revenue growth, but it's not too high. Now we are looking for free cash flow growth, which is very important for us because this is how the company could pay the dividend or can buy back the shares. So we want to see this growing over the last 5 years. So if we take a look here in 2019, it was around 11 billion. And now in 2023, it's around 28 billion. So this is looking good. They could grow the free cash flow, and it's a check here. Now we are looking for a free cash flow yield over 4%. So this can also tell us about the valuation of this company. So if it's under 4%, it could mean the company is overvalued. So we're going to take the free cash flow from 2023. It's 28 billion. And we're going to divide it with the market cap that we already have. So this will give us the free cash flow yield. Okay. This is about 11%. So we have an incredible free cash flow yield of over 11%. This is really amazing actually. So this can mean the company is undervalued. But obviously, Chinese companies are often undervalued, so we cannot only judge this company by the free cash flow yield. Now we are going to take a look at the balance sheet. So we want to see the debt to free cash flow ratio under 5. This means the company can pay back the debt with the free cash flow in under 5 years. So it's a very important number for us because if the company has too much debt, it also can lead to bankruptcy at some point. So what we're going to do now, we're going to take a look at the short-term debt that we see here. It's 24, a little bit over 24. So then we're going to add the long-term debt as well. You can see it here, 68.7. And then we're going to divide it with the free cash flow. And then we will get the debt to free cash flow ratio. That is very important for us. So we get the number 3.32. So in a little bit over 3 years, we can pay back the debt with our free cash flow. This is a very good number actually. So we can make a check here. Or we can also take a look at the cash on hand because Chinese companies often have their very good balance sheet, or they also have a very good balance on the bank account. So we can see here they have over 226 billion in cash on hand. So this is a great number. It's actually more than they have debt. So they can pay the debt with this cash on hand and have even money left to buy back shares or to pay the dividend. So they look very good in the balance sheet and the financials as well. So it's definitely a check here. The last thing we are looking for would be shares outstanding decrease. This means the company buys back their own shares. So this is very important for us, especially for this company, because it looks so undervalued and we would like to see the company buy back their own shares. This can help the stock price to increase. But we can see here, they did buy back shares in 2020, but the other 3 years, they did not buy back shares. They increased the shares outstanding. So this is what we don't like to see. Now in 2024, they did buy back shares, but in a small amount. It's not so big at all. So it's not a check here. And I just think they should buy back more shares. This is a very important for this company because this can help the stock price. And they're also not paying the dividend. So at least we would like to see the stock buyback. I would like to give my conclusion about this company. So let's start with the good things. They are the market leader in search engine. They have other products as well, cloud and autonomous driving. They have a great cash flow. They have a great balance sheet as well. So they look very cheap and undervalued with the balance sheet, with the free cash flow. So the negative thing would be new competition. So there are other companies like their TikTok company, which also wanna creating their own search engine. So they have a lot of competition there as well. And what I don't like, they don't have a dividend and they have a very small stock buyback. So we want to see somehow that they give their money to the shareholders back. So in the way of stock buybacks or in the way of dividends. So we would like to see that more because the stock price keeps dropping and we need to see something from the company to helping against this drop. So the stock price is in 1 year down close to 30%. So if they buy back their own shares, they can help the stock price to increase again. So we would like to see that more. So I hope you liked the video and please don't forget to subscribe and like the video.